Welcome to Policy on Demand. I'm Pat Brown. I'm pleased to be joined today by Will Morris to get a deeper take on the deluge of OECD guidance released this week. Will, welcome back.
Thank you very much, although this is becoming a habit that I think I need to break.
So look, in addition to the stack of guidance we've been going through, which I see you have brought with you, helpfully, we also want to talk about the G20 meeting this week in India. So could you describe the big picture for us? So what did the inclusive framework, this is of course the OECD countries plus the 100 or so other countries that participate in the process. So what did the inclusive framework report to the G20 and what was the outcome of this week's G20 meeting?
Right, so the OECD Secretary General, this was the fifth document which came out yesterday, released a report to the G20. It is, I think, safe to say, relentlessly upbeat, as you might expect it to be. But it talks about progress. It talks about a lot of the work which has been done in relation to the Pillar 2 rules, the new Pillar 2 rules that we've seen, global information return, subject to tax rule, which is very important for developing countries. And India has been in the lead on that. And then obviously the amount B that we saw. Now, we haven't yet, we're waiting on there won't be a communique because of issues with some of the G20 members.
Right.
But there will be a statement. And it will be interesting to see what that says. That should be out very soon. What we do know is that, and this was in press reports in the past couple of days, India has pressed very strongly for the amount allocated under Amount A to be increased from what we've seen, the 25% of profit over 10% for the very largest companies. It will be interesting to see whether the statement reflects any of that. As we know, that there are disagreements. Concerns, developing countries, larger developing countries, including the G24. So it'll be interesting to see how that's reflected. But the OECD, very positive spin, if you will, on everything that went there, and more to come.
Yep. So Pillar 2, which is very much in the here and now for companies, we got two big sets of documents, right? We got further administrative guidance, if you will, a second tranche of administrative guidance. And we also, of course, got the global information return, which goes right to the heart of what will the compliance burdens be for companies. So what do companies need to know about this guidance that came out?
As we mentioned yesterday, there are two safe harbors. There is the transitional UTPR safe harbor, and then there's the permanent QDMTT, qualified domestic minimum top-up tax safe harbor as well. And what they will both do essentially is to reduce the top-up tax to zero. With the UTPR, the temporary safe harbor, it delays it for another year. So although that's for calendar year taxpayers, actually interestingly for half-year taxpayers or whatever, it would actually extend this well into 2026, but other than that, to the end of 25. There are a couple of requirements. It applies just to the UPE jurisdiction, to the home country, and to tax rates of 20% or above. This is relatively laser focused on the United States.
I'm trying to think of a large country that has a rate at 20% or higher.
That's right. I'm sure there are others as well. Right. And why is this? Well, as the document explains, it is to give countries more time to get their house in order. Equally, one I think could realistically see it as more time to have a political discussion which needs to take place to solve the UP jurisdiction. Obviously, that's related, as we discussed before, to the pressure which has been applied, at least this year, by the new Ways and Means majority.
Right.
And I think that's important. There are a couple of things that people need to bear in mind on this. There is obviously this transitional UTPR safe harbor. There is also a transitional CBCR safe harbor. With the CBCR safe harbor, if you fail 1 year, then you're out.
Right.
And it's important to note that even if you qualify under the UTPR safe harbor this year, if you don't qualify under the CBCR safe harbor, you will not be able to apply the CBCR safe harbor next year. So that's I think, one to watch there.
Right.
There is this permanent safe harbor for QDMTTs. Again, there are just one or two little things to bear in mind there. There are three standards there. I'm going to read them out. There's the accounting standard, the consistency standard, and the administration standard. For the accounting standard, what's important to watch there is that it does allow countries, in certain cases, to apply local accounting standards, so not the parent standard.
Right.
This is going to increase complexity. It may also increase the amount of information, different types of information, which have to be applied. So again, I think that's one which is worth watching on that. As you said, there are also things in here on credits, and in particular on transferable credits. And obviously, in one sense, this is This is good news. This has been a big issue, particularly with the Inflation Reduction Act. Again, they make very clear in the documents themselves that the Inflation Reduction Act has sort of vastly increased the scope of transferable credits.
Right.
And therefore, they need to look at that. So there is now a category of marketable transferable tax credits. There is no end to the acronyms that this project has done, which are effectively treated as qualified refundable credits. And again, that is largely good news. There are some things which need to be watched. Again, in that there is a requirement, as there was with the tax equity structures, tax equity partnerships, that this be marketable.
Yep.
And that therefore there cannot be too large a discount. And it's also worth bearing in mind, again, as with the tax equity partnerships, that the amount which is actually paid for the credit will go on the income line. The amount of the discount will come out of the tax line. Put differently, if there's a $100 credit or 100 whatever it is credit, and you pay 90 for it and you get a discount of 10, 90 will go to the income line, and 10 will go to the tax line. And obviously that has a big effect on the ETR. But again, I think it's worth bearing in mind. With the UTPR safe harbor, again, I think it's worth bearing in mind, exactly how much is this going to buy us? Because they make very clear in that safe harbor, this will not be extended. This cannot be extended. Now, never say never, as we've already learned. But that is a relatively strong statement there. With the Globe Information Return, one of the big things we were looking for there was how much constituent, this is a tongue twister, constituent entity level by constituent entity level reporting does there have to be?
So fundamentally the detail, how much detail?
How much detail. And what they do, and this I think is very useful, is essentially there is a 5-year delay on that level of detail. A lot more detail can be done at the jurisdictional level. So there is what they call a transitional simplified jurisdictional reporting framework. I'm not even going to go into the acronym for that. Where again, there are 2 qualifications for that. The first is where there's no top-up tax for the jurisdiction, or the top-up tax for a jurisdiction doesn't need to be allocated by constituent entity. It's applicable for fiscal years beginning on or before the 31st of December. Now, one thing again, which is important about this, one reason why businesses really, really, really wanted a long period on this and some certainty at the end that they may not have to go into that level of detail is so that, and you'll remember this from your days in business as well, so that they didn't have to go in and start the work of changing the ERPs. To do that transformation right now. It is questionable whether this safe harbor, even for 5 years, will give companies enough comfort to say, well, we need to start this now. And that, I think, is something which is going to play out over time. But one other helpful thing which is in there, this has been a question as well, as to how much of this information is actually going to get spread around, how many countries are going to get this. It makes very clear that only the UPE jurisdiction gets the entire Globe Information Return. Jurisdictions with taxing rights under the Globe rules will be provided with relevant parts of the GIR. And then all jurisdictions which implement these rules will get a very high level of detail. Maybe not in the end terribly different to what they would have got under CBCR reporting.
Right. So there's a lot that you just went through there, Will. So I'm going to try and summarize quickly for our audience. So on the Globe Information Return, some relief on the constituent entity level detail, but for a period of years. And to your point, what does that really mean when it comes to the investments that companies need to make in building compliance systems? We don't know, and companies don't know. That's an important point to consider. This point about sharing of information obviously has, I think, crept more and more into the conversation recently in the confidentiality of data. So good news on that as well. Again, qualified good news, but good news. On the administrative guidance, good news on transferable credits. It's nice to see that. Your point about the competing or overlapping safe harbors, the UTP safe harbor versus the C/C safe harbor, that's obviously going to be one for companies to watch. And just to emphasize something that you said at the very beginning, this is a question that I was getting yesterday as well. The UTPR safe harbor, this temporary safe harbor for calendar year taxpayers is 1 year. The guidance is worded a little bit oddly in that regard, and I got some questions from companies. So just to note, if you're a calendar year taxpayer, it's 1 year. That language, like all the language in these documents, has to be read very carefully. Okay, so Pillar one.
Indeed.
Not to be neglected entirely.
Not to be totally neglected.
Right, in our discussion. So we were expecting, as of a few weeks ago, that we would see the multilateral convention. Right. We did not.
No.
But we did see some documentation indicating some progress on Amount B. So
right.
How do we think about, what do companies need to know as they think about this guidance and where things stand on Amount B?
Right. So, I mean, Amount B is something that many businesses have been very interested in because not every sector, to be sure, but lots of companies do have what are effectively routine marketing distribution functions in a number of countries. And they have transfer pricing disputes about that. And if you could determine what, sort of the fixed return to that was, then you might pull this out of those transfer pricing disputes. And that would be a benefit. Obviously, however, that needs countries to agree to what it is. And, sort of the home country often wants that to be a very low amount.
Right.
And the source country, the incoming country, the market country, whatever you want to call it, wants it to be a much higher amount. So what we have seen here is some progress on Amount B, but it's important to note that this has been put out for consultation. One should always welcome consultations, but they do also indicate sometimes a lack of agreement amongst countries, and that's certainly what we're hearing. On the other hand, some of the things which they suggest, that there are two different ways of looking at this, could be quite interesting. And they talk, for example, about how scoping would be done. Should Amount B, for example, include a criterion to scope out distributions which essentially go beyond those baseline marketing and distribution functions? But there's also, detail on the pricing grids that they would use. There is a pricing matrix, for example, which provides a grid of the arm's length returns expressed as returns on sale, and then links that to specific features of what the distributor does. So there's more stuff there. It is great that business has been invited to consult upon this, and obviously business should really, those of which are interested, should very much do this. It's an open question in the end. I mean, we saw this with BEPS, with value-added services, I think Action 10, where countries couldn't agree in the end, what that level should be. And that may still be the outcome here. However, given the possibilities, business should really be involved. And one other thing to note, this is not really tied to Amount A in the end. Amount A, multilateral convention, we'll have to see what happens with that. But with Amount B, they would be incorporated into the transfer pricing guidelines. So there is a separate channel there if countries can get to agreement.
And that point about incorporating Amount B into the transfer pricing guidelines, all the more reason for companies to be engaging in this consultation, because even if you are skeptical about whether or not Amount A and the multilateral convention is ever going to enter into force, these Amount B calculations, computations are going to be relevant for companies moving forward. So Will, we're going to leave it there, give you an opportunity to draw breath. Thanks for joining and welcome.
You are very welcome. Great.